The third quarter of 2012 clearly was a strong uptrend in the market. Stand past rally going into Q4. Traders expect volatility to come back, not only because of the national elections here and what's going on overseas in Europe, but it's that time of year, October in particular, where we see that volatility come back into the market. Straddles and strangles are strategies that we're taking a look at. Tell us a little bit about that.
Yeah, straddles and their close cousin strangles are quintessential volatility strategies. When you think the market is going to move wildly, but you're unsure of direction, you can trade that with a straddle or a strangle.
What would the difference be?
Well, a straddle is when a trader buys a call and a put sharing the same strike price in the same month. A strangle is very similar. It's where they buy a call and a put, but they have different strike prices. And typically, both the call and the put are out of the money.
So is there a difference with margin requirement, experience level? I've always traded straddles relative to strangles. Does it really make a difference in the professional world? What about on the retail level?
I think it's more common in both professional and retail to trade straddles, but each have their advantages. Straddles are more expensive, so therefore there's more at risk. Strangles are a little bit cheaper, but the underlying stock has to move more for them to have a profit.
And it's strictly a volatility play. So essentially, if you don't know the direction of the underlying, you just know that volatility is going to move, and that's where you're going to capture your profit. How does the break even work on something like that?
Sure, it's fairly simple. A trader would simply add up the premium paid for the call and the premium paid for the put, and add that to the strike price to find the upside break even, and subtract that value from the strike price to find the downside break even.
So if we're looking at something like $60 and we paid $4 for it, we either need to move to 56 or 64 to be profitable.
Exactly, and sometimes that can be a pretty big move. So if you're looking for a very small increase in volatility, you might want to hold back and explore some other strategies, but when you're looking for the market to really pick up in volatility significantly, it's a great strategy that can really hit a home run.
So is there a stock that you're looking at now that could potentially be a great volatility play?
You know, there's plenty of stocks out there. One of the things that a trader always needs to do before making a straddle or even a strangle play is to look at the implied volatility. It's a little bit tricky right now because implied volatility is kind of high across the board. So that means that when you buy a straddle, the premiums are more expensive. They're inflated. So there's more at risk, and the underlying stock has to move further to permeate those break-evens on either side. So it's tricky now. It's always a balance of, yeah, I think the market's going to move more than expected, and I want to try and buy these straddles cheap when I can. So there's some back and forth.
So was it a more rational strategy to do in Q1, Q2, where we had a little bit less of that, straight upside momentum that we've seen? Because the past 12 to 13 weeks have been incredible.
Yeah, you really have to be very, very selective and look for those candidates that are going to have more volatility than the market in general, more volatility than traders expect, and you're going to look for those trending breakouts either way.